Welcome to another episode of Millennial Investing Explained. Here's today's question. Say someone invested in a stock and the company has done very well, just like they expected, profits have grown, but the stock has actually stayed flat or maybe it even declined a little bit. For whatever the reason may be, maybe the market is just being cyclical or the market's being irrational, but for whatever reason, the stock declined. How can a new investor overcome the mental hurdle of not seeing those profits actually hit their brokerage account?
So Warren Buffett, in my opinion, probably the greatest investor that's ever walked the planet from like a stock investing point of view. I'd say it's between him and Dalio at this point. Buffett has a quote. He says, "The stock market is a voting machine in the short term, and it's a weighing machine in the long term." And so when a person hears that, they're probably thinking, okay, so what in the world does that mean? Well, what it means is everyone's got an opinion. There's craziness driving the short-term market behavior, and that's why I would argue that you can't do it successfully, because there's no way of really knowing whether bad news is going to hit in 10 minutes from now and drop or raise the price of the stock. There's no way people can actually know that. That's called insider trading, if you do know that, and it's against the law. So it's a voting machine, and it's kind of going all over the place, and it's trying to find what in aggregate people think it's worth. But what Buffett would also tell you is if the price drops and you know that the company is of value, so let's go back to our $50 example. Let's say we bought the company at $50, one share at $50, it makes $5 a year. Some bad news came out, the market got scared, and it drops down to $25 a share. But the company's still producing a profit. In fact, they might even be still producing the same $5 profit that they were making before. And if they aren't, maybe it's $4.75 now in the profit. But you can now buy it for $25 and not $50. So what Buffett would tell you is you got to buy more of that stock because it just went on sale. It would be like going into a store and the jeans that you used to buy for $50, you can now buy for $25. It's the same pair of jeans. Well, you would buy two pairs of jeans and try to sell the other pair or whatever. So in the long term, the stock market is all about a weighing machine. And what he means by that is the person who's accumulating more and more shares at great prices are the people that's going to get a really fat return. Because let's go back to the yield that you're getting on that company. If it's, let's just for simplicity say that the profit is still $5 a share, but now you can buy it for $25 instead of $50. Well, when it was at $50, you were making a 10% return. But when it's at $25, you're making a 20% return. So whenever it goes on sale, your yield goes up, assuming that your profits are similar to where they were at before. And this is where it becomes a weighing machine and you need to load up on it. And so it's just a change in mindset. And most importantly, it's all about patience. If you think you're going to knock out 100% return on something in 6 months, you can do that in some type of markets, but you can also lose 100% of it in those same markets. So if you want to make a lot of money fast, I'll tell you, your risk is sky high. If you want to make a lot of money slowly, your risk is maybe lower depending on what your approach is and how thoughtful your approach is. But I would tell you it's lower and it's more methodical. And the person who has the correct protocol, that has the right process and the right mindset, and I would argue you're owning a business, folks. Whether you want to believe that or not, you're owning a business when you buy a share of stock. Okay, you're an owner at that point. Whether you believe it or not, you're an owner. And the more that you can start to think like an owner, I would argue the more success, long-term success you're going to have. You'll be in the game for a very long period of time if you think like a business owner.
I think the biggest takeaway there is the long-term horizon. I think that is so important. Over the short term, a market can certainly be irrational. It can go up or down without reason, really. But over the long term, 5, 10, 15, 20 years, the markets will generally price stocks correctly. And that's why it's so important to hold them for the long term. That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.